Welcome to Season 8 of the FarrCast, bringing you insights into Wall Street, Washington, and the world. Now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is the first day of May. Hooray, hooray. It's the 1st of May. Wonderful. Springtime has struck. And hooray, hooray was my favorite Professor Dr. William T. Koch, professor of English at the University of the South, and my dear friend, loved the 1st of May. All of his former students will remember. All right, as we look at the 1st of May here, second month here in the second quarter of 2025, the volatility continues. Earnings are coming out apace. Lots of earnings this week. We had pharmaceutical earnings, we've got tech earnings, we've got earnings left and earnings right, and most all of them are pretty positive. Certainly the tech earnings are positive, pharmaceutical earnings are positive. Warren Buffett's annual meeting is tomorrow, and as we look at the levels for markets, we are seeing some remarkable things, folks. You might be getting used to it, but the S&P 500 is 5650 right now. Yeah, 5650. We were at a high of around 6160 at the beginning of the year. So we're basically down 500 points, 10-ish percent maybe on the S&P 500 from those highs, not overall, but from those highs. It's a decent pullback. Oil is a bigger and a bit stranger story at $56 handle, 56.87 this morning on oil. Gold still hanging strong at 3,200, and the 10-year Treasury 4.139, 4.14, let's say, 414 on the 10-year. That's a big rally, which means that yield has come a lot lower, which means interest rates really in the past couple of weeks have become much more affordable. And the big President Trump scare of those higher rates after his Jay Powell comments has abated. The big scare has abated. It's come back down. This size of a rally is a bit perplexing because you expect to see it on a flight to safety trade. This is a fear trade level, just the way it strikes me. It's been too much of a move higher too fast in Farr's opinion. We'll see what Polcari says, but that's just my opinion. Too far, too fast. When the market's going up, when you see futures that are way up this morning based on earnings, the Nasdaq futures are up almost 1.75%. 1.75%, 335 points higher. S&P futures are up over 1%. When those things happen, you typically see Treasury yields go higher and not lower. Well, that's not happening. But bunches of earnings, so we do have fundamentals out there. And you get these stronger days, and as an investor, you say, maybe that's over with. Maybe it's over. Maybe we've put in a bottom. Maybe I can go back to digesting my breakfast, which I haven't been doing for the past month or so. Maybe you can, and maybe you can't. We'll see. I think it's probably premature to think that the volatility has ended or to think that the president's approach to policy and negotiating is really going to change a whole lot. He likes it. And indeed, what we're hearing on Squawk Box this morning with Joe Kernan and Andrew Ross Sorkin agreeing that the terms of the deal that they're hearing about in Ukraine are actually positive, something middle of the road where Ukraine will not be abandoned. The president seems they found a middle ground. These polarizing initial positions. Is this all art of the deal? Is it all starting to work out? Are we all going to be fine? Seems early to declare victory and run home, but I want to see what my friend Polcari thinks. I continue to be a little bit cautious, but encouraged with higher prices. Kenny Polcari is the chief market strategist for Slate Stone Advisors. And my dear friend, welcome back, Kenny.
Michael, it's a pleasure to be here. Thank you very much for having me. And, I'm on the same side with you on a lot of those things. I do think that the rally back has been a little bit too far, too fast. But guess what? We had some exciting news out of, there was all this angst building up over the hyperscalers, the Microsoft and the Meta and Amazon and Apple. And we're going to see how that plays out again tonight. Last night, you saw, they just crushed it, both of them, on their metrics, on their margins, on their growth, on their CapEx. They're going to spend money. They're going to do all this stuff. And so that took all that angst that, the market was kind of holding in, and you see what's happening today. To your point, the market is in hyper rally mode pre-opening. So we'll see.
And those companies, Kenny, a lot of them reported. I mean, when you look at the Meta, you look at the Microsoft, and you dug a little deeper on those numbers, there's a lot of free cash flow coming for years and years, years of streams of free cash flow that are forecast, ladies and gentlemen. Past performance is no indication of future results, but there are sales lines and pretty clear views from those companies. This is not Farr's opinion, not Polcari's opinion. These are reports from the company. We are not making any recommendations to buy or sell any security whatsoever. We're just telling you what the companies reported overnight. Okay, Kenny, sorry. What did I miss?
So I think that's obviously adding to kind of the excitement today for sure. But look, we're going to blast right through the short-term trend line, which you identified right now. We're right at 56.50, which is I mean, it closed at 55.69, but futures suggest we're going to open at 56.50, which is up significantly and blasting right through that trend line. I think, all the excitement again tonight, they're going to be waiting and anticipating about Apple and Amazon. We've also had some good earnings already this week. CVS came out. They hiked their forward guidance. They talked about their insurance business. So there is a lot of kind of this brewing excitement. But like anything, you can go too far too fast. And all that means is, you'll just kind of retrace a little bit. Doesn't mean we're going to go down necessarily test the lows at 48.35. But I wouldn't be surprised if we see, we'll have a good day today, and then we just may see ourselves churn a little bit as we just try to digest the moves.
Let's talk about a couple of lessons here, because you and I have both been dealing with clients who suffered. We heard from clients who were suffering, and they wanted to sell everything, and they said, no, I can't do this. And they would mention different stocks, and this one can't do well during a recession, and that one's going to do horribly if we have these tariffs, and this, and you hear the litany. And part of what we did was say, listen, we're doing this for a long period of time. I hear you. If a client tells us to sell something, we will sell it, of course, ladies and gentlemen. But
it is their money, so you have to do what they want. But to your point, part of what we do is help people through this process and helping them understand that what they own are high quality names, mega cap names in the industry, names that will rebound once this kind of comes down, and looking exactly what's happening.
It feels like we've pulled back. I mean, it feels like we got into a calmer moment here, Kenny. Is there a lesson for those folks who were clearly, I'm not chastising, I'm not criticizing, I'm not saying, oh, shame on you all for feeling that way. Hell, I felt that way. Kenny felt that way. It's what we did about it. And I will tell you, there was one thing that I did sell out of my portfolio that I'm not sure I should have sold, but it made me feel better at the time. I still make those mistakes at times. I do. And after 37 or 30, how long we've been doing this, Kenny? Long time, right?
Yeah. I mean, I got a Ford from mine.
It still gets you. Whenever 1987 was. So however many years ago that was when I started. So what can we say we learned? Because we're feeling a bit of relief now, but I'm suggesting that period of relief might be transitory, might not be. Sorry, J. Powell, I hate using your word too, but temporary. How about that? We may be back into the deep weeds of fear again before the end of this year. In fact, I would tell you to count on it, folks. How do we find lessons learned, Kenny?
Listen, what you have to find lessons learned is look at exactly what happened when you were feeling your worst and you wanted the blowout. You meaning just in general, the people that said, no, I can't take it anymore. They turn around and they look how the news can change and how you give it a chance, and the names that you own rally right back. And, I'll have this conversation right after I get off the phone with you with a client who last week sat down and he begged me to get out. I go, listen, I'll get out. I'll do what you want. I'm telling you, I think you're making a mistake. And so we're going to have a conversation there, because he's already texted me saying, thank you very much. Because the lessons learned is that, you need to not be emotional. You need to understand what you own. And if you own crap, then you got to get rid of it. But you and I are not investing our clients' money in those kinds of names. We're in the big mega cap names. We do our homework. We do our due diligence. We understand what the stories are. And unless the story has changed fundamentally for each one of those names, riding it out over the long term and reinvesting the dividends that you get paid is the way to growth.
So two things there, because I think those are excellent points, but two things I want to take away from that. One, even though we do the work and we stay the course and we stick to our discipline, we still make mistakes. Everybody makes mistakes. I get skewered about the mistakes in the portfolio when markets are going down. Nobody wants to talk to me about Microsoft and Google or Nvidia or anything that's doing well when the market's going to hell. They're going to pick the three stocks that are down and explain to me why I'm an idiot. And the folks, I know why I'm an idiot. I've been an idiot a long time. You don't have to tell me this. But the other thing, Kenny, is I think to my first point, about your client you're going to talk to, you need to, I would tell him, this is Farr's advice to Polcari, tell that guy that could easily see that portfolio and should expect it to see in this volatility, that 100,000 go away. The 100,000 that he's up in the past week, it's going to go away again, and it might go down another 50,000. But these days will come in the future.
100%. And look, this portfolio was down. Right? When the market was at its lows in April, this portfolio.
Oh my God, the portfolio went down when the market went down? Why is that such a shock to everybody when it happens?
And today, listen, if today is what it looks like it's going to be, this portfolio is going to rally in this portfolio. So that's going to be this conversation that I'm going to have with him today, because look, not in a negative way, but in a way that kind of assures him that what we're doing in the portfolio we created for him and the names that he owns are good, solid names that are going to provide him and his family what they need going forward.
What do you think about $56 a barrel oil, Kenny? What does that tell you about future global growth expectations? And then we got to go.
I actually think oil is going to go a little bit lower. I said, look, I think we're going to test 55, which was the low we saw in April. And if we don't hold 55, then I think 50 is going to be 50 is going to put right in the spotlight. But I think oil's down 24% since January 20th when Trump came in, right? That is going to certainly help inflation. It's going to help transportation costs. It's going to help manufacturing costs. So on the one hand, yes, oil is lower, but there's all these positives on the other side that it's going to help. That's going to help achieve for the U.S. economy and for the global economy. So I'm okay with it. I'm actually looking. If it goes to 55, I'm okay with that.
Are you still buying, Kenny? Are you still buying? Or are you looking on these periods of strength to trim some things that you might be worried about should the economy continue to contract?
So I'm not going to, today I'm going to let it go. I'm not doing anything today. I'm not buying nor selling at all. I'm going to let today just rally. But if we see another pullback.
Hang on, give me a second. Wait. Why? Because so am I. Why? Why do you do that on days like today? Because you and I would, I bet everybody, I'm telling you, unless there's a, stinker in your portfolio, that's what most everybody of our experience is going to do, and discipline.
Right. You're right. Because you got to let it ride. These are the days where you're going to make up that when these stocks are going to perform, they're going to show you what they're made of. And so I'm not chasing stock. I'm not going to buy Microsoft up, 35 points today. It's going to run. It's going to churn a little bit. Like you said, it's going to adjust. It'll pull back a little bit. On a pullback, if I need to buy more, I'll buy more then. I'm not chasing it on an up day like today. I'm not chasing anything on an up day like today. It's just not what we do.
It's not what we do. I love that. Kenny Polcari is what we do on the FarrCast. He's the best face and voice of Fox News and Slate Stone. Thank you, Kenny. Hey, ladies and gentlemen, we've got Dan Mahaffee coming up and Shelby McFaddin from the Motley Fool. She was with us before. Absolutely terrific. She is a senior analyst there, covers economics and markets and stocks, and talks about her approach coming up later in our show today. So thanks for being with us. We're going to be right back.
Michael Farr is the longest tenured CNBC contributor, and we'd like to invite you to a special behind-the-scenes look at CNBC. Coming on June 5th, Fast Money from CNBC is hosting a behind-the-scenes viewer experience of the live show at the Times Square NASDAQ market site, followed by an in-person meet and greet with Melissa Lee, Guy Adami, Karen Finnerman, Tim Seymour, and the entire Fast Money team. Join fellow Fast Money fans for the ultimate exclusive in-person interactive event with Melissa Lee and the traders. Book your exclusive ticket today to this private event and watch the live broadcast in the Fast Money VIP screening room at the NASDAQ market site in New York City, followed by an in-person Q&A with the traders, photos on the Fast Money set, and an opportunity to mingle with Melissa Lee and the Fast Money traders over cocktails. For more information and tickets, go to cnbcevents.com and select the Fast Money Live tab. And now, back to the FarrCast. Thanks for being with us this week. Now it's time to go to our political analyst, Dan Mahaffee, and your host, Michael Farr.
Welcome back to the FarrCast. Joining me now, as he does every week, Dan Mahaffee, the president of the Dr. Scholl Foundation, senior scholar at the Center for the Study of the Presidency and Congress, and our senior political analyst on the FarrCast. Welcome back, Dan.
Good morning, Michael. Great to be talking to you. Thank you.
We are very glad you're here. I hope I just gave you a promotion somewhere in one of those titles. Ladies and gentlemen, if we talk to Dan week to week about what's going on in Washington and how things could turn up or turn down, Dan, we're on an upturn now. Markets are higher. The president, we're hearing, has some sort of arrangement deal with Ukraine, and we're going to get the details here, perhaps even over the weekend. Should be a positive. And the language is starting to sound different. And we were also hearing this morning a little bit of gloating from some of the more conservative commentators who were saying, see, Trump starts out hard to one side and then he comes to the middle and this is the way he does a deal. You all need to sit down and shut up and relax. Well, okay, I still don't like the volatility. I don't like the unpredictability. I don't like the uncertainty. And it doesn't suit my level of politeness, frankly. It doesn't just seem very civil. And I'm actually a fan of civility, and I think the world needs more of it. But, Dan, what are they missing or what have they got right? Because it would be wonderful if we could solve something in Ukraine.
Yeah. No, let's look at the terms of that, and we don't know exactly what is the terms on the sheet, so the details will come out. You see, though, a change in the message, at least the terminology used in these statements. One of the things that folks had been concerned with was the administration seeming to soften American rhetoric on Ukraine. We'd seen different measures at the United Nations blocked by the administration, softening of language on Russia at G7 summits. But then you see this statement last night that comes out with this from the Treasury, the rhetoric used by Secretary Bessent himself. Very clear that Russia started this war. Russia is the one who invaded Ukraine, as well as language too, ensuring that measures are in this so that no Russian companies, Russian entities involved with the Putin regime or military can benefit from this. So very strong language, given the sense that, there were some talking about worst case scenarios of, Trump signing this and handing Ukraine's resources right over to Gazprom or something like that. Look, so you do see at least positive momentum, particularly given the arc we've had from that Oval Office blow up through the different negotiations. Perhaps now this one-on-one meeting in the Vatican maybe was a bit miraculous in some ways between Zelensky and Trump. But ultimately, the deal does tie the Ukrainian and American economies together. It's clear that there will be some level of defense commitments, although those haven't clearly been laid out from what I understand. So it is unclear what kind of military equipment the Ukrainians would get. But at least in Europe, too, this does soothe some of the concerns about Ukraine being abandoned. Ultimately, though, the question still becomes, what's the level of military support? Is there enough U.S. military, logistical, and intelligence enabling that can go on in the background to encourage the Europeans to deploy more of their equipment in the future? And ultimately, too, what is the patience of the president with Putin, given that we've seen these statements of considerable frustration from President Trump that Putin is now dragging him along?
So we've moved quite good distance away from the Oval Office tantrum, whether that people called it an ambush, people called it a bunch of different things. Others said no, he stepped into it and he was not respectful, and people listened to more. What was that strategic? Was it planned? And was it effective, Dan?
Look, I don't. You can argue its effectiveness and its outcome. I don't know, though, if it was effective truly in the sense of, is it effective if your goal is to shake up our allies and get them out of their complacency? Okay, you could argue yes, but that process would take longer than perhaps any one administration, even if it is kickstarted now. But as you talk about the costs, the questions of civility, questions of American leadership, you have to ask yourself, is it worth it? And like the economic policies discussions we had over the past couple of weeks, as with all of these, you fall into, if people talk about Trump derangement syndrome, I'll slightly modify it to Trump Rashomon syndrome, which means that, like the old Kurosawa samurai film, everyone fills in their own version of the story they want to get out of the meeting or decision by Trump to fit their politics or their goals, when it's ultimately what he decides at the end of the day between those negotiating in front of him.
Okay. Well, so it sounds too, as you mentioned, that we are not using the soft buddy delicate language with Russia anymore, or with Putin. That Besant was pretty tough. So we're not fawning over Putin as much in current statements. Do you think Trump keeps that up?
Well, again, that's the question, and how much of it is also the different entities you have involved in these negotiations. It was Besant and a team at Treasury leading this with the Ukrainians. However, it's Steve Witkoff, the real estate developer, who's doing most of the one-on-one negotiating. And where do Rubio and General Kellogg, who are, Secretary of State respectively, and the envoy, a former military general, General Kellogg. So all these players, where do they fit in? And it is a very good question. And ultimately, the only person who can answer it is President Trump. On how long does he keep that language? Is it consistent, or is it simply language that is there because that's what was arrived at the Treasury negotiation level, and maybe superseded by presidential comments in a matter of days?
I'm gonna just interrupt one and just go off on one of my tangents. But I've been reading a book, Dan, that's fascinating. Ladies and gentlemen, this is a book called Nuclear War. Nuclear War. It's written by Annie Jacobson. It is fascinating and it is terrifying, and it begins by explaining exactly, second by second, and reams and years of research have gone into this book to make it precise and factual. Interviews with and quotations from former presidents, secretaries of state who had been involved in this process of what happens when a live nuke would go. And it begins by a nuclear bomb hitting the Pentagon, and then taking you second by second what happens in the destruction and the aftermath, second by second. And then, as we get through all of that and the fallout is coming, then the same process starts again in the next section, where what happens at all of the missile sites at the Pentagon and the White House, minute by minute, and how much time the president actually has to make a decision as to whether we return fire and essentially destroy most of the world. In this scenario, it was fired by North Korea. They were wondering if it was errant, and then in the process they find in this scenario it's not errant. But boy, I'm learning a ton. A lot of it I wish I never had to learn, Dan. But this chain of command and how Washington works and who follows what, when you go back and what you just said was, all of this really does come down to the president. I think it's hard sometimes for a lot of people to realize how much every day comes down to what the president wants and how the president wants to run the agenda and whom the president wants to send into these negotiations. And just because you're the Secretary of State doesn't mean you're going. I'm going to send the real estate guy because I think he's better. Well, so what am I doing over here as Secretary of State? Is what I'd say if I were Marco Rubio. But this is something that you do see under a lot of different presidents, but not quite as obviously as this one. Am I getting that wrong?
No, you're not getting that wrong. And this is hardly the first presidency where you've talked about the different casts of characters in the White House and what they do and how they support the president, from the brain trust around FDR to who Truman drank bourbon with and who the Kennedys hanged out with and what the LBJ's closest circle of advisors was when he was talking to them from the commode. All of these things are parts of presidential style and history and decision making that are all there, and you have to consider them as part of the nature of how decisions are made in the White House, and that does then weigh on the questions of, as we talked about, be it allies or businesses. What are the decisions being made? What is the course being put on? And is it a predictable course?
Yeah.
And those are the questions that I think, be it national security, economics, or others, that the uncertainty created by a presidency can be one of the most damaging things to it. And that's where I ultimately think the lesson for the Trump administration in its second term is going to be, if they don't get through this moment of economic uncertainty, and in a sense of the message that they've put across, it does look like you started to see in the Biden administration, when the Afghanistan withdrawal really took away any sense of certainty about what that administration was doing.
So you're really saying what we're doing economically right now, and we've got to get through this period. This is absolutely critical for the president, because there are so many headlines, Dan, that it's hard for anybody to follow this stuff. And you've got RFK, who says he's now going to have placebo vaccines for new vaccines to see if their real vaccines are going to work. And one would expect that if there's some new vaccine out there, it's to address some sort of new disease that's threatening our population. So it's hard to, when you get those headlines out there, it's hard to focus on, can I still watch the economy? Should I still be watching the price of oil? How do I know what's important?
No, that's the question, and it's are these tariffs, are these programs being done with a sense of encouragement? We're being told, what's the strategy for this? What is the message on these, given that on one hand they are proud to, the president holds up a table with the rates themselves on television, proudly pointing at them, but no, God forbid we see it on our receipts, what they actually cost. So you have the questions that are coming up are not ones that show them in charge of this plan or putting their plan forth. It is their own plan, and now they're being reactive to the criticisms of it, which doesn't suggest that they had a strategy for rolling this out or putting this forward in the first place, which you would have expected if it was going to be the kind of buckle your belt, prepare for hardship, we've got to get through this, but to right the ship type message that they're now throwing out later.
GDP was down yesterday, which means the gross domestic product and growth in the U.S. contracted during the first quarter. The economy shrank during the first quarter, ladies and gentlemen.
And let's remind all our listeners, since time is a flat circle right now, that first quarter were all numbers before the tariff announcements.
So second quarter doesn't particularly bode well, even though we've got some good earnings announcements out now. We are hearing about what happened during the first quarter in the rearview mirror, and we've got to see more with the tariffs. But it's still a very dicey, unpredictable time. Very quickly, Elon Musk looks like he's out and moving away. That lasted for about a quarter or 4 months maybe for Doge, because he started before the inauguration. Is he really gone, Dan? Number one. Number two, how long does RFK last in this position? He's taking a lot of headlines. Typically, Trump doesn't like it when others take too many headlines. Or is this guy enough of a distraction from Trump that Trump's actually using him and liking him?
Well, I think you have the calculus first on RFK. The Trump calculus is always how much does this satisfy my base versus what I need to govern. And
30 seconds. I got 30 seconds.
Trump has always been happy to reward his base there, so I think RFK stays. On the other hand, again, the ultimate question: don't if the voters didn't want Democratic weirdness, the answer is not to counter with Republican weirdness.
Not to counter with Republican weirdness. Okay. Well, it depends what takes the headline and spotlight off of whatever the president doesn't want you focusing on, i.e., certainly doesn't want you focusing on what tariffs will actually cost on Amazon. That didn't last long. We were going to see prices there. And Jeff Bezos said, oh, no, no, we're not going to do that. Never mind. We're not going to add the price increase on those Amazon prices. By the way, that was the responsible CEO response. That was the response. You might have wished that there was another political response, but if you're running Amazon, you don't put Amazon in the president's crosshairs when you know that he can be vindictive and he doesn't forget. So we'll see that. I think if you're the CEO, it probably made sense. So, Dan, final word, we've got to go, and we've got Shelby McFaddin coming up next.
Yeah, keep an eye on the Middle East. I think where we see what we're doing with Yemen, certainly increasing the tempo there. But question becomes, what can we do there that hasn't already been done in effect of getting rid of the Houthis? Because they've been a persistent threat, and one where you question what really is the impact on our security. As the vice president himself even questioned in that now famous leaked signal chat.
Well, they're the threat to Israel, right? So we're going to we're putting pressure on a threat to Israel, is what it seems.
Yeah, that would seem the case, but it's the question is how sustainable is it, given to that we need these carriers, missiles, platforms, etc. if we are going to worry about a conflict with China.
Dan Mahaffee is the president of the Dr. Scholl Foundation, our wonderful friend and senior political analyst on the FarrCast. Thank you, Dan. We're going to be back with Shelby McFaddin. Please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. I am Michael Farr. Terrific segment this morning. Kenny Polcari, interesting on what he's telling clients. He's got a big meeting coming with those clients where their guy wanted to sell everything a week ago and now is up $100,000, $150,000 almost in a week, and is going to be a happy call. Will Kenny warn him and tell him it's going to go down again? I hope he will. Joining me now, one of our FarrCast fan favorites. She's only been on once, which is a big failure of Harry's, I think, because I blame everything on Harry. I do nothing wrong. It's great. The best thing about having a producer is that you can blame them for everything. And so we'll blame Harry for not getting Shelby on more. She is a senior analyst. She's economist. She's portfolio genius at the Motley Fool Asset Management, and really one of the more thoughtful and articulate and nicest people we get to talk to. So Shelby, welcome back to the FarrCast.
You know, Michael, that's quite an intro. I got to thank you for that. And thank you, Harry. It's a pleasure.
Don't thank Harry. Gosh, don't thank Harry. Okay. So Shelby, we've seen the S&P 500 go from 6160 earlier this year, now down to 5650 or so today, and that's after the surge pre-market open on all of these tech earnings that seem to be very, very strong. McDonald's not so much on those earnings, one of their lowest same-store sales since 2020. What do you see going on here with this pullback? How do we feel so good today with this pre-market strength when we're really down 10% from those highs earlier this year?
I think the excitement that we're seeing is really the classic case of lack of breadth in the market, right? But when we look at the rest of the broad market, we look at the rest of the Russell 1, the rest of the S&P 500, it's not that great. We're seeing the effects of people getting a little bit more cautious, and the performance, the sort of guidance tightening, the guidance revocation, the sort of saying, look, we're going to go quarter by quarter. We're not going to try and get ahead of anything this time. That is sort of being a little bit drowned out by the success that we're seeing in the companies that have frothier valuations, who basically have bills that have come due. They need to constantly be able to say, we are making good use of this capital allocation, and you don't need to pull back your investment yet in regards to anything related to AI. And so I think that that's sort of what brings the market forward. But when we actually go ahead and look at the state of all of the companies that are in the S&P and in the Russell 1, we see a very different picture. But I don't think anyone's rushing to go ahead.
Tell me about that different picture, Shelby. What different picture are you seeing there?
Well, and there we're seeing a bit more caution, right? Because there's a lot more connection to broader industrials and consumer behavior than we're seeing just in the sort of pure play, let's say big six in tech, really. So you have to consider much more in terms of economic data when we're looking at the rest of those companies for them. At this point, it's everything that's related to cloud and data solutions versus other companies that are significantly more tied to consumer behavior. They may not yet be seeing the volume drawdown, but they are definitely starting to be either tighter on guidance, so they're tightening those ranges, or they're saying, you know what, we're going to keep our guide for next quarter, but we're pulling our guide for the second half. And that's mainly because it's not as much tied to enterprise. Consumers don't have contracts with individual companies, how much I'm going to buy from them over the next 10 months. But these
Right.
enterprise businesses do have contracts, and that determines their cash flow. So they can already see a little bit what's going on. They can see a few months out, potentially a couple of quarters out. And so if anything, that also can sort of cause rather than a dilution, a concentration of optimism in the market.
We talked about that in segment one, and some of these forecasts and the strong cash flow coming in from a lot of these companies looked rather encouraging. Are we being distracted, Shelby, because we want to be, because it's convenient, because it feels good, and we're tired of feeling bad? I mean, I've said earlier in the FarrCast today that we're looking in the rear view mirror, and we're looking at a quarter that didn't really, it had a lot of political froth, but it didn't have the tariffs in place. And these tariffs are real and are impacting companies. Are we having a little bit of selective attention span here, do you think?
I'm going to agree with you, Michael, and I'm going to say yes. And
Okay.
one of the biggest pieces of evidence for that is just valuations, right? I mean, with all we have gone through, I am still hesitant to say, yes, it's time to buy everything that's been on our short list. Even in the decreases we've seen year to date, in many names, it's still not enough. There's still some multiples that are just in the stratosphere. And so there is a sort of collective agreement that, okay, we're all just going to kind of stay put, right? The way I've described it with colleagues has been we're in a game theory class, right? Prisoner's dilemma. Who's going to be the one that says this is ridiculous? These valuations make no sense. Because if you make the move, how quickly can you get out before everyone else tries to do it? So now everyone just stands at each other, guns drawn, and goes, well, if you move, then what happens to me, right? So there is an element, obviously, where we know that there's a fundamental part of AI taking these companies to places they haven't been before. But to what degree can we really hold that in our hands with where these valuations are? And I think there's quite a bit of a gap there. And then when it comes to the rest of the macro and the policy that's related to these things, it's changing constantly. And so I think the market at this point has chosen optimism And it's hard to say drop it when we're not quite sure what the depths of pessimism will bring us every 3 days.
And you know, everybody wants to keep making money. And a lot of them don't have the stomach to lose money. And if you own stocks, you will be down on average 14% over the life of the holding period at some point from your purchase price. Some 14% pullback you're going to have in stock prices. So we know that the downtimes are part of owning stocks. Do you have the stomach for it? And I talked to Kenny Polcari this morning in our first segment, and I said, so Kenny, what are you doing today when you look at an up day like this? He said, nothing. I said, me too. I'm doing nothing. Absolutely nothing. I'm going to let this settle down, shake out. If there were something that just was stinking to high heavens in my portfolio and I got an opportunity to get out of it, that maybe I'm getting a second bite at the apple that you normally don't get, I might take that. But otherwise, my strategy doesn't change just based on where the short-term market levels go. What are you doing? What do you advise clients? And then I want to talk about oil.
Yeah, so I actually had a great discussion with our chief strategist yesterday, and we realized that acquiescence in this environment can really be your edge. We've had people say to us time and time again, what are you buying? What are you doing? You must be doing something. And
Right.
we'll look back over a 10-day period and say, not really, because it doesn't change what the fair valuation that we've come up with. That doesn't necessarily change just because there are swings. And the other thing is these swings have a pretty big breadth, right? Everything is moving roughly the same except small caps. Small caps just get beat up every time. But when you look in the large cap universe, there's not these really large fractures in terms of, well, this industry is going this way. They're all kind of just doing the same thing. And within peer groups, they're largely moving in a pack, right? So we're not making these sort of timing decisions. And often we see situations where there's something we're interested in and it's trading at 50 times free cash. The swings in the market are only bringing those down to about sometimes 43 times free cash. Big whoop. We're still not super excited about it, right? So we decide to set.
Those are really expensive levels, by the way, ladies and gentlemen. Those are really, really, really expensive levels. So, yeah, from 50 to 43, nobody cares. 43 still stupid, is what she's saying.
Still stupid.
Sorry.
And so we'll sit tight and we'll say, let's just continue to wait. So we acquiesce to the fact that there's going to be volatility, but we are not giving up. We are not walking away from watching the portfolios. We're continuing to have a look. So when we look at our Global Opportunities Fund, that is something where we've got US exposure, we've got international exposure as well. And we have some of the most tried and true, but also expensive companies in that portfolio. So we've got very mature companies that have performed like growth companies, right? We were not chomping at the bit to buy those in the down market because they are still quite expensive. But we're also in no interest in just selling them because we're thinking, you know what? It just keeps going. Let's get rid of it. No, they're really, really reliable companies. We trim, we take some gains as needed so that we can allocate to companies where we do think that either in this market situation or in other market situations, they've come off enough to say, let's add. But we're not making these big decisions on saying, you know what, I bet tomorrow there's going to be a headline. And if as long as that headline brings the markets down 1,000 points, then we're going to start buying. That's absolutely not the sort of thing that we're engaging in. You can be active without constant activity.
Right. And I think, you know, what we're also saying and what you're saying and what most disciplined portfolio managers say is, I have a discipline and a plan, and I am at pretty much every minute proactive for the long term, and I'm not reactive. And reactive gets you into emotion. And as soon as you become emotional, you start making mistakes, folks. I promise. So follow Harry Jennings' advice. Don't just do something, sit there. What's part of some of the best investment advice you'll ever get? Don't just do something, sit there. Oh, and by the way, folks, if younger people, if you're listening today, do you want to be wealthy? If you want to be wealthy, I want you to learn 6 words, and I want you to say them frequently, freely, and proudly. You ready? Here they are. I'm sorry, I can't afford it. I'm sorry, I can't afford it. Take control of your financial life. I've been meeting with too many young people lately, Shelby, and they say, well, I've got to do this and I've got to do that, and all my friends are going on this vacation, and I can't just not. Yes, you can.
You
Keep
can.
your money. Be secure. Build your nest egg. Be responsible. Take care of you first, and the hell with what everybody thinks of you. I'm sorry, I can't afford it. Smile if you want to when you say it. Don't smile. I really don't care. Just say it. Okay, Shelby, I got to get to oil and then we're going to get out of here. Oil is my other example I want to get to because it was $80 a share in, I'm sorry, $80 a barrel in January, $80 a barrel in January. It's now, below 60, 57, 56 was the handle on it this morning. So I'm back to the markets being wrong. Now think about this. This is the price of a global commodity that in 3 months, in 90 days, is 25%, almost 30% lower than it was 90 days ago. What's happened in the supply of oil? It's not a supply issue. Our supply hasn't changed 25% in 90 days. Is this real pessimism over global growth and the prospects for global economic growth? Because when you see real expansion, people use oil and they use it for transportation and they're using it for shipping and they're using it in construction and use the damn stuff everywhere. But now these prices are really down. How does the price of a global commodity go back? How does this swing like this? And how do you explain it to clients? Because sometimes when they ask me, I go, "Oh hell, I don't know. I've never really understood oil," and I certainly say that about gold. And they look at me like I won't give them the answer. No, I don't understand gold. I've never understood gold. I can't tell you why the price of gold goes up ever. Give me that flight to safety stuff, and it's a reserve of this. Years ago, there was actually, when you look at the demographics in India, the younger people in India are all reaching marrying age and they're all going to be buying gold, and there are a billion people in. Oh, shut up. Shut up. The marrying age people in India are not driving the price of this global commodity. They're up another 1,000. No. But anyway, okay, my rant is over. Tell me what you think.
Well, for one thing, I think your clients are very fortunate because it takes a strong advisor and really just a grounded investor in general to say, you know what, I don't work on oil, right? And at our team, we don't spend too much time looking specifically at commodity-based opportunities. There are some times where we'll look at different things like where oil meets the land leases, right? Like that's a space that we will sometimes operate in. But to answer your question in terms of how do we get this swing in 3 months, and I do think it follows the sort of sentiment line, right? When we've looked at the container ship data, which I think so many investors have been looking at that over the past 2 weeks,
right?
It doesn't look great. When you look at that gap, and you then draw a line to what's going on in the oil market, well, the line is at least, it's bright enough to see from a few feet away, right? And
Yes.
so it's a situation where sentiment can drive the market, where it's typically just supply and demand. Well, now we're sort of looking at, okay, what might demand be? Okay. And so is that going to be an issue? Because when it's just a situation of, let's say it's extremely cold weather or something like that, there's a cold front that's just going to reek through the United States. You might see a little bit of price movement, right? Because people aren't going anywhere. But now let's take that cold front and let's multiply it by roughly 3,000 times and call it the container ships will not
Yes.
be moving as much as they have. There will be a pretty large gap in time where there's not as much trade moving. Or it could turn out to be a short gap, but we're not sure how long or short it's going to be. So then the pessimism enters the market and we say, all right, well, let's just go ahead and price in a global slowdown. When we're thinking about commodities, they're trading roughly for exactly what they're going to be worth. When we think about equities, it's okay, how much is the sort of are the future free cash flows plus any sort of other premium that I want to add on there, risk, safety, so on and so forth. But when we think about gold, we think about oil, we think about wheat, corn. It's just what is someone else willing to pay for it, given how much of it is available in the market and how much they're going to need. And so it really is still a supply and demand question. It's just a question of, is there so much pessimism about future demand that we've brought prices this far down? And I would have to, at this point with the information I have, I'd have to agree that that's at least a contributing factor, that there's just concern about how much trade is going to slow down for any period of time to the point where it might bring oil down to sub 60, even sub 50.
Shelby McFaddin is the senior analyst and resident genius at the Motley Fool Asset Management. If they don't know that, you tell them I said so. Brilliant, articulate, engaging, and entirely charming. Thank you so much for being with us. As much as I gave you a strong intro, I undersold you.
I really appreciate that, Michael. It's always great to be here. I was ecstatic when the team got the notice.
Well, we're really happy to have you. Harry, get on it, get her back. Ladies and gentlemen, that's it for another FarrCast as we cover Wall Street, Washington, and the world, bringing you insiders like Shelby McFaddin to help us better understand the world around us and what it means for our investments and our economy. I learn so much every week. I hope you do too. Thanks for joining us this week. And hey, if you're up in New York, you heard Harry telling you at the breaks about this CNBC opportunity to go and meet with the folks and attend Fast Money at the NASDAQ and a reception afterwards. I think that sounds like it'd be, I go to these things from time to time and they're fun and I like to meet I will not be there, but it's a cool deal. So if you're in New York and you want to do that, that's a really fun thing to do and meet those folks and sit in the studio audience at the NASDAQ site up there in New York. Okay, we'll be back again next week. Do it all again. Are you ready? From Sheboygan, Wisconsin, I thank you all very much this week. I'm Michael Farr. See you next week. Bye.
That's a wrap on this week's episode of the FarrCast. Thanks to our guest, Kenny Polcari, Dan Mahaffee, and special guest from the Motley Fool, Shelby McFaddin. And thanks to you, our listeners. Please share us with friends and colleagues. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of assistance here at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course across the changing investing environment. We are grateful for all of your notes and comments, and we try to respond to as many as we can. Please keep those emails and messages coming. Join us in coming weeks as we continue to bring you guests with insight from across economic, diplomatic, political, and investing realms to give you insight into our ever-changing world. Until then, take care, stay safe, and stay healthy. I'm producer Harry Jennings. Thank you for listening to the FarrCast, Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates assume no liability or any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr Miller in Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.